Merci beaucoup de cette introduction très amicale. Merci beaucoup aussi de l'invitation à faire ce discours au sein de cette conférence. Je m'excuse de continuer en anglais. Je crains qu'il y ait trop de termes techniques, commençant par subprime, où je ne saurais pas vraiment le terme français. So, systemic risk in the financial sector, market failure, and government failure. I want to propose to you the proposition that the crisis is not just the result of misbehavior, nor is it the result of misbehavior of some particular kind, but lots of things came together, many of them identifiable beforehand, but a major role was played by system failure. So, to some extent, well, and some of the system failure, I will argue, is in fact related to a misconceived regulatory setup. In terms of regulatory discussion, what you see all over the world is that regulators say, if only there hadn't been all these loopholes, the crisis would not have happened. Let's just close these loopholes. I think that if they were to look in the mirror, they might find some of the causes of the crisis as well. And one thing that surprises me is that on the side of the regulators, there has been no post-mortem of the sort that UBS has done for its own, on its own side, as to what has gone wrong and where could we have done things differently. So, as general remarks, the crisis has not just one cause, but several. I would like to distinguish between two triggering events and then a flawed financial system architecture. The triggering events were the subprime mortgage crisis. That's something you probably all know. The other triggering event was a breakdown of what I would call excessive maturity transformation, borrowing short to lend long, borrowing at a few months maturity in order to invest in securities with a horizon of several years, where you never know what happens if your refinancing disappears. And in fact, this did break down in August 2007. Flawed financial system architecture. I submit that between August 2007 and September 2008, we've seen something like a downward spiral in the financial system that drove basically on its own dynamics because of the way the system was set up. And the spiral involved price declines in markets, the way these price declines entered into bank books, and then the way in which banks, in the context in which they were, reacted, in particular by, as it is called, deleveraging, i.e. selling assets, and you know what asset sales do. They contribute to further lowering market prices. I begin by pointing out that in terms of numbers of the subprime problem, we have a puzzle, or rather two of them. If we go back to the IMF's, the International Monetary Fund's Global Financial Stability Report of October of 2008, and I use these numbers because the later reports don't separate the numbers anymore. At that time, they argued that The total volume of non-prime mortgages in the United States, that's to say of mortgages that do not meet a certain quality standard called prime, was on the order of 1,100 billion US dollars. Their estimate of losses on these securities and derivatives was on the order of $500 billion. Now, if you look at this second number, there are two questions that arise. Why is it so large, and why is it so small? What do I mean by that? Well, the number seems large if you relate it to probable losses on underlying debt service. If you had someone who was able to hold the entire stuff, it's likely that until maturity, it's likely that the value of the proceeds would be significantly greater than the value at which you get when you deduce the 500 from the 1,100. A loss rate of 45 to 50% just seems too high. So what are these losses? Well, these are not losses from defaulting borrowers. These are losses from markets valuing these securities at lower prices. And the first puzzle is that the losses in terms of market valuations seem large relative to prospects of losses on the debt service on the underlying securities. Second puzzle, if you compare this to the entire world financial system, 500 billion is a small number. Bank assets prior to the crisis were on the order of 80,000 billion. By comparison to that, 500 is small. What about other crises? Realized losses in the Japanese crisis of the 90s are estimated at something between 500 and 600 billion US dollars. How much of that has spilled over to Europe or to the US? Anticipations of losses in the American S&L crisis as of 1990, numbers were floating around between 600 and 800 billion. In the end, when things were cleaned up, it was only 160 billion. But at the time when everybody thought that this is really bad, the numbers that were mentioned were on the same order of magnitude as what the IMF has quoted here. Did you have any notion of the American S&L crisis here, except for perhaps a newspaper headline on the odd day when the newspapers didn't have anything else to write about? So the second puzzle is, why is it that this particular crisis spilled over to affect the rest of the world? In April 2007, the International Monetary Fund actually presented a very detailed study of the subprime mortgage crisis. And the numbers were a bit smaller, but in terms of identifying what the problems are, there's really nothing that's missing in this document. And then they ended up saying it's quite unlikely that this will have any effects on the rest of the world's financial system. At a conference that the BIS, the Bank for International Settlements, organized on financial stability and the macroeconomy in June of 2007, no one talked about subprime. There was no inkling that this was about to happen. There were discussions of hedge funds. So why did nobody foresee this? That's part of the puzzle. So, let me go through the actual analysis. I begin with a brief overview over what subprime itself is actually about. To some extent, this is past history, but it provides some basis for understanding that this wasn't just altogether a crazy thing. First observation, real estate is always a problem. And real estate crises have been a source of financial crises and financial risk on many occasions. The problem is that real estate is just a huge chunk of assets, to some extent highly correlated, and when things in real estate move, that moves a lot of other things as well. Now, any journalist who writes that if only these banks hadn't invested in those crazy mortgages, these risks wouldn't have been there, must either be saying that somebody else should have borne these risks, or that we should all be living in tents. Surely, if we were living in tents, the cost of real estate, the amount of wealth tied up in real estate, would be somewhat smaller. I doubt that any of you would be willing to forego the living standard that you're enjoying to live in tents just in order to avoid the risk of financial crisis. So, if we don't want to live in tents, somebody has to bear this risk. And then shifting this risk away from the initiating bank and shifting it away from the borrower is a good idea. Shifting at least some of these risks away. I don't have the time to enter into this, but if you look at past experiments on what's a good system for bearing real estate risk, there was one experiment in the United States from the 30s to the 80s, which had this risk being borne by savings institutions, with the result that as of 1980, about 2/3 of American savings institutions were technically insolvent. The insolvency wasn't uncovered because they didn't have to put it in their books, but it was there nevertheless, and was a major reason, the major reason for the ensuing savings and loans crisis. Another experiment was engaged in the 80s in various countries, in particular the United Kingdom. Shift, for instance, interest rate risk to borrowers by having adjustable rate mortgages. Well, when market rates of interest go up and the bank tells the borrower, you have to pay more interest. Well, in the late 1980s in the United Kingdom, the borrower said, we can't. We have borrowed up to our utmost capacity to pay, and therefore, if you raise the rate of interest, we've got to default. And the bank said, fine, we'll repossess the property. But property markets were depressed. And this is not an accident, but when refinancing costs are high, interest rates are high, real estate prices are likely to be low. These things are correlated. So that experiment also didn't work. Actually, on that occasion, it wasn't the banks that suffered, it was the insurance sector, because the banks and building societies had insured this credit risk, obviously an insurable risk, with the insurance companies. So trying to find someone else who can bear risks is a good idea. But the problem is to do this in a way in which you don't destroy the incentives of the initiating banks to actually make sure that the credit risk is appropriate, that the borrower can fulfill his obligations. The German system of securitization of long-term debt through what's called Pfandbrief is able to do so. That means the bank just issues an obligation of a maturity, in theory, an obligation of a maturity equal to the maturity of the mortgages it holds, and then there are lots of risks that it can just forget about, except if the individual property is not worth very much. The individual borrower is not behaving well. The bank still carries that risk because all of this is an obligation of the bank. The assets that are issued are an obligation of the bank. And the final investors can get to the bank if they want. Now, in the case of mortgage securitization in the United States, this did not happen. In fact, all the risks were shifted to investors. This was initially invented by so-called government-sponsored enterprises, Fannie Mae and Freddie Mac. Let me not talk about what the meaning of these acronyms is. They're called government-sponsored because they enjoyed certain privileges, and many people thought that they were actually backed by the government, which officially they weren't, and in the end ended up being anyway. Now, these institutions actually guaranteed the debt service on these mortgages, and they insisted on quality standards. That's the meaning of the word top prime. Subprime is the stuff that Fannie and Freddie wouldn't take. So these two institutions actually resolved the incentive problem. Not ideally, because if the initiating banks had retained some liability, maybe they would have looked even better, but still, by imposing these standards, they ensured some quality. Now, in the early 2000s, the private investment banks in the US found that this was a profitable business and moved into it and had two innovations: no guarantee and subprime rather than prime. And they didn't hold on to the last tranche in this operation, the worst tranche, the tranche that bears the first loss if something goes wrong, but sold those. And thus, nobody, neither the originating mortgage banks nor the investment banks, had any incentive to take care of the quality of the clients. And you know what happens if nobody has an incentive to take care of anything? Well, quality declined. One measure of this, there was a 15-fold increase in fraud on the side of mortgage borrowers over the decade from 96 to 2006. And many of the delinquencies, irregularities in terms of the contract, were actually discovered even before the first problem occurred with payments. So there was just a lot of not looking closely enough to avoid fraud. That being said, if one looks at delinquencies in terms of late payments, there is empirical research showing that delinquency rates 12 months after the contract increased continuously during this time. Not actual delinquency rates. There were years when delinquency rates went down. In 2005, delinquency rates were quite low. Why? Well, because the market was booming. And if your real estate is appreciating, you don't want to default on your mortgage. Now, the empirical research asks the question, suppose we keep mortgage prices fixed, what can we then say about the quality of mortgage performance? And there the answer is quality went down continuously as this market expanded in the early 2000s. What happened to real estate prices? Well, they have been fairly stable throughout most of the 90s. From 1999 to 2003, they increased at some 10% per year. Then over the next 2 years, the growth rate jumped to 15% per year, and then it went down, and in the summer of 2006 turned negative. So these price increases for the first years of the decade just hid the declines in mortgage quality. In principle, an economist would expect that if the institutional setup is such that there are no incentives to take care, there's going to be some external discipline exerted. Market discipline is one of the magic words of modern finance. Well, there was very little of it. First of all, the rating agencies, the agencies attesting to the quality of assets, just didn't pay much attention to the creditworthiness of the borrowers because they thought that with real estate prices appreciating, there wasn't much to worry about. And they didn't realize, maybe they didn't want to realize, that the factors that made real estate prices go up might also change and make them go down again. And some of these factors, in fact, could not persist all the time. So one reason for the increase in real estate prices was that refinancing costs had been lowered quite dramatically between 2000 and 2003. And that, of course, could not be repeated. They also failed to understand, and this is a notion that I will come back to over and over again, the role of correlations, different risks moving together. I had before given the example of English insurance companies insuring credit risk. That's plausible if you assume that one person's creditworthiness is independent of another person's creditworthiness. But it's a very bad view of the world if both persons' creditworthiness are driven by the same underlying factor, like the increase in interest rates in the United States, in the United Kingdom in the late 1980s, like changes in real estate markets, as we will see in a few minutes. What else happened in these markets? Well, nobody was willing to really look at what these assets were. Everybody was interested in yield. If you ask why were the first loss tranches, the so-called equity tranches, the tranches that really carry the liability of this stuff, why were these tranches purchased? If you go back a few years, everybody uses the word yield hunger. Hedge funds were hungry for securities that provided yield. So were investment banks. And then you have this puzzle of European investment banks moving into the securitization business themselves. And being a latecomer, they didn't securitize mortgages. So they didn't take packages of mortgages and resell them in tranches. They took packages of mortgage-backed securities of medium quality, sold them, issued several tranches, and said the most senior debt on this stuff is really high quality. So you take a package of BBB rated or unrated, quite poor quality stuff, put it together and hope that you get something which is of no risk, which might make sense if these risks were uncorrelated. This is where the word comes again. But if they all move together, there is no gain from diversification from packaging this stuff. And the European investment banks didn't worry very much about the risks of the stuff that they were picking up because they wanted to resell it anyway. You get to, so what the stuff that they sold was called MBS CDO. That's a collateralized debt obligation that has mortgage-backed securities in as a collateral. You have MBS CDO squared, that's a collateralized debt obligation that has mortgage-backed, that has MBS CDOs as collateral, and so on. And very few institutions looked at the risk. If you take the example of UBS, here we have two features that I really find quite amazing. UBS Investment Bank was involved in the securitization business, and they held on to some of the stuff that they issued for the simple reason that they liked the rate of return. They liked the rate of interest, which was a few basis points higher than what they could have gotten on other stuff with similar ratings. The fact that this was highly correlated with the things that they held anyway because they needed to store the stuff while they were in this procedure was completely forgotten. The other feature which I find quite amazing is that senior management never got to see a full-fledged account of the business model of UBS Investment Bank and the risk that was involved in this model. That's a failure of governance, which I find quite remarkable. I suspect that as long as UBS Investment Bank was producing nice rates of return, they didn't really want to look too closely, which of course raises questions of how, what kind of discourse does one have to organize these things. Now, top management in banks, management in hedge funds, and so on, of course, also were driven by the need to account to their investors. Shareholder value is a term that has become prominent in financial discourse over the past 20 years. I remember in the 80s it was a dirty word, at least in corporate boards. And it has become prominent in the dialogue between corporate executives and analysts, corporate executives and journalists, so-called market discipline, and of course all of that focuses on yield to shareholders. We may wonder why. That's another subject. But I definitely believe that there is a yield bias in market discipline. In an organization where managers have compensation based on stock market performance, I think there's also a yield bias in internal governance. And here we may wonder about the effects of bonus systems. Now that's only one piece of the story. That's the piece of the story, subprime, which, as I said before, is too small to explain the world financial crisis. It's the most complicated piece to understand, but it's only one of these pieces. Second piece, many institutions, typically US investment banks, and then German state-owned banks, engaged in maturity transformation, borrowing short to lend long. They financed investments in mortgage-backed securities by issuing short-term commercial paper. Now, if they had done this in the case of state-owned German banks, if they'd done this in their own books, the supervisor would immediately have forbidden it. So what did they do? They had these subsidiaries. They're called conduits, and here you see the word SIV, structured investment vehicle. Hardly any equity. Put mortgage-backed securities, invest in mortgage-backed securities, issue very short-term debt to finance that. How did this work? Well, the sponsoring institution gave a promise of liquidity assistance. If the short-term refinancing was to fall away, the sponsoring institution would do it. So in the case of the state bank of the Free State of Saxony, Sächsische Landesbank. They actually had such liquidity assistance promises amounting to 42 billion euros when their equity was on the order of 3 billion euros. These promises were not on the books, because if you don't believe that they're going to be called, they don't have to be on the books. And the supervisor didn't say, but this is too risky, putting all your eggs into one basket, and the creditor's eggs as well, or the taxpayer's eggs, putting all of them into one market. Well, the supervisor said, regulation against large exposures only applies to promises extending, having a maturity of more than 1 year. All these maturities are below 1 year, therefore we don't have to intervene. Because none of this was on any of the books, nobody really knew about its extent. Why did they do this? Well, these institutions don't really have a business model of their own, certainly not the German state-owned banks. Yield panic. Where do you earn the return that you need in order to fund your costs? Like the 200 specialists that Bayerische Landesbank used to have in New York. Plus the spending wishes. I mean, Bayerische Landesbank is an institution that should be funding, I don't know, projects in Bavaria. They actually had 200 specialists in New York. Of course, you also need to fund the special wishes of the politicians in charge, but that's minor relative to some other concerns. In the context of the investment banks, the American investment banks, you have a similar element, because the repeal of the Glass-Steagall Act forbidding commercial banks from doing investment banking had changed the rules of competition, and in certain dimensions, investment banks had a much easier life because they were part of the Federal Reserve system, had access to the Federal Reserve discount window, had a depositor base for their own finance, and that was much easier to handle than what the investment banks had. So one suspects that some of that may be involved in institutions taking these kinds of risk. Of course, this kind of risk-taking was also encouraged by US monetary policy. From 2002 to 2004, you had a federal funds rate somewhere between, that's a short-term money market rate, somewhere between 1 and 1.5%. You had a 10-year rate on US treasuries, perfectly safe securities, somewhere between 4 and 5%. That's already quite nice, a spread of 3 percentage points. On prime mortgages, conventional prime mortgages, the rate would have been 6%. Fixed rate subprime mortgages, the rate would have been 7 to 8%. Borrow at 1%, invest at 7 to 8%. Doesn't that sound like a great deal? Temptation was quite substantial. Restrictive monetary policy set in from 2005 and 2007 and triggered the turnaround. In many ways, this is a disaster of a repetition of Mr. Greenspan's go and stop policies of the late 80s and again the 90s. He had done this kind of experiment twice before. So how did the crisis proceed? Well, the triggering event, as I mentioned before, was this twin event in August 2007. The rating agencies woke up to the fact that mortgage-backed securities were of poor quality and downgraded these securities, some of them by 3 steps at once, something that had not happened before, at least in the corporate sector, which immediately affected the prices of these securities and immediately meant that these various special entities that had no own funds, no equity of their own, had a problem because their assets were less than their liabilities. And their financiers immediately called in and said, we're not going to give you money anymore, which means that they had to call on their sponsors. So Sächsische Landesbank immediately went under because it had problems with those 42 billion euros. So the shock in all this for the system was the amount that was involved. There was an estimate that this kind of maturity transformation amounted to altogether 1,000 billion US dollars. Remember before I had said that non-prime was 1,100 billion, 1,000 and 1,100, that's a big chunk. Now, even if some of these assets are not in subprime, but in other kinds of asset-backed securities, it still is a big chunk. And any system of financial markets where the institutions holding long-term assets find that such an amount needs to be refinanced because their refinancing sources don't trust them anymore, any system like that is going to have a big shock to digest. This is why I'm saying that there really were two shocks. They were interrelated because these institutions were in mortgage-backed securities, but excessive maturity transformation is a sin in banking which is much older than these newfangled derivatives, which is, by the way, why I've never understood why the regulators didn't, and supervisors didn't step in to say, regardless of what the rules say, we have a right to prohibit unprofessional banking practices, and this kind of maturity transformation is an unprofessional banking practice. Now I get to the system part of the story. So you have a price decline. Price declines are particularly pronounced after a shock, are particularly pronounced if the market doesn't work well. And these markets didn't work well. Now these price declines immediately had to go into the bank's books, and the banks had to write up losses, which generated the problem that they had to do something about their loss in equity. Recapitalize, deleverage, i.e. sell assets. Let me explain each of these points on its own. First, market malfunction. There were information problems. What's the value of the asset that's being traded? And when there are information problems, every buyer bewares. Changes in risk perception, changes in perceptions of own vulnerability. I have to worry about the people who give me the money. And all of this depressed these markets. To some extent, depression may also have had to do with an anticipation that, well, if tomorrow somebody else has to sell, the stuff will be even cheaper. So why buy today when tomorrow prices may be lower yet? And there is some indication that in some of these markets we may have seen something like a downward bubble. You may ask, why did nobody buy? Well, some institutions probably did buy. But the question is, who would have felt strong enough? Who would have felt strong enough also vis-à-vis his own financiers to actually buy these securities? I've heard quite a number of people say, if I was able to wait for 40 years, maybe just 20 years, I'd really buy this stuff and make a killing. There are very few people able to do that. Fair value accounting. Under the regulatory arrangements for capital regulation for so-called market risks, that's assets that are traded in markets where the bank worries about risks to market prices, one prerequisite is that you use mark-to-market pricing according to markets all along. And this even if the markets don't function. Then you replace mark-to-market by mark-to-model, whatever that may mean. You have a model of what the write-down would be, what the price would be if the market were functioning. So there were large write-downs, and these went on and on and on. The repeated nature of write-downs had nothing to do with banks not knowing what problems they had in their books. They had something to do with these problems becoming ever more serious as market prices declined ever more. And banks didn't have enough equity to cope with the problem. There are two levels at which this is an issue. The first is there were hardly any buffers of equity in excess of what was required by the regulator. Now, one of the paradoxes of regulation is that if you have a required buffer, that ceases to be a buffer, because that's what you need to satisfy the regulator, and you can't use it to buffer shocks. So to respond, you either have to replenish it, find someone who gives you new equity, like the government fund of Singapore to UBS, or you have to sell. How much do you have to sell? Well, that depends on what the losses are and what is the relation of your equity to your balance sheet. In some cases, well, it might be the case that for every dollar or euro or Swiss franc of losses, you have to sell 40 times as much, or 50 times as much, or 100 times as much. And that's a really large multiplier. Why that much? Well, required capital had been much reduced, and in fact, in some institutions, well, equity was on the order of 1%, 2%, 3% of the bank balance sheet. When you read a newspaper article saying we have 10% core capital, we're wonderful, that doesn't mean that they have 10%, their capital is 10% of their balance sheet. It means that their capital is 10% of the so-called risk-weighted assets. And if there are enough assets that have a risk weight of 0 or a risk weight of 0.1, it can mean anything. And in practice, if you take the case of UBS, 40 billion Swiss francs out of 1,600 billion, that gives you 2.5%, which gives you a multiplier over of 1 over 2.5% equal to 40. That's the 40 I had before. Now, the problem with this very small equity is that you immediately get into a mistrust about solvency. Mind you, UBS's losses in mortgage-backed securities and related activities are far in excess of the 40 billion in equity that they had before the crisis. So they would have been insolvent if it hadn't been for Singapore and the Swiss Confederacy. When there is distrust about solvency, well, are you going to lend money to an institution that you don't trust? There you have interbank markets breaking down, and this of course added to the sense of vulnerability of these institutions. Now, central banks have on a number of occasions tried to resolve the problem by providing additional liquidity. But of course, central banks cannot really deal with issues of solvency. They can only provide liquidity. The US Treasury thought that it could restore a sense of orderly procedure and save money by letting Lehman Brothers go under, leaving the European creditors of Lehman to bear the costs. I think they've since found that this was a miscalculation, and that led to the explosion last September, which then led to government governments worldwide stepping in and having the taxpayer provide a guarantee. Let me take a step back a bit and ask, what's gone wrong? Who is to blame? And I think here we need to distinguish between misbehavior and faulty system design. And I think it's very important to make this distinction because many of the problems arose not because people consciously or subconsciously misbehaved, but many of the problems arose because people didn't understand and couldn't understand the risks that were actually involved because there was a significant degree of fragmentation and system dynamics. Misbehavior, I've already talked a lot about yield hunger, excessive maturity transformation, a focus on growth. More interesting, perhaps, improper risk modeling. Risk models, both at institutions and at rating agencies, to the extent that they had models, were improperly constructed, involving a lack of understanding of the fact that there are non-stationarities, meaning things are not the same, even probabilistically, period to period to period, and that there are correlations between different risks. Example of correlations: UBS had hedged some of the credit risk of mortgage-backed securities with third parties, in particular the so-called monoline insurers, and subsequently eliminated these risks from their risk models because, after all, they've been hedged. The fact that maybe the third parties, the monoline insurers' ability to actually pay would vanish at the very moment when it was needed, that correlation of risks was not being considered. Also, there was a complete lack of understanding of the fact that there are risks that you cannot capture in the model. For instance, nobody knew, as I explained, about the extent of maturity transformation through these special entities, the shadow banking system. I don't blame people for not having known about this. But I think one can blame people and for not having put this risk into the models. But I think one can blame people for not having sufficiently taken account of the possibility that there are always things in the world that you have neglected to think about and that in some sense you must provision for. Of course, there has been improper risk control. I gave the UBS example for that. Misbehavior, well, the regulators tolerating loophole, not banning unprofessional behavior. The politicians creating an atmosphere where the regulators worried of being accused of putting sand into the wheels of national champions. The Swiss National Bank actually raised questions about the equity of the Swiss big banks long before the crisis and proposed a leverage ratio rule long before the crisis and was turned down with that, not just by UBS and Crédits, but also by the Swiss Banking Commission and also by the Swiss Finance Ministry. And everybody knew that if this dispute was going to go into the press would be on the side of the national champions rather than the Swiss National Bank. In a sense, at this level, everybody has to look in the mirror. Faulty monetary policy, I have already mentioned. Flaws in system design. Lack of accountability and liability in the whole process of mortgage origination and securitization, including the further dilution of responsibility in the further rounds of securitization. Intransparency of what markets' position were. There has been a decade-long discussion on whether or not hedge funds should be regulated. And this has usually been brushed aside with the argument that Investors in hedge funds are really sophisticated people and don't need to be protected. That's fine if you believe that investor protection is the only objective of regulation. What about systemic risk? It would have been very good for institutions like UBS or Deutsche Bank if they had had some information of what the aggregate exposure of other institutions was, what the average, the aggregate maturity transformation at other institutions was. This would have enabled them to anticipate at least some of the second shock of August 2007. At the level of system design, we also have to worry about internal governance in banks, market discipline of private banks, and in the German case at least, complete failure of governance in public banks. We also have to worry about regulation. Capital regulation itself, designed to create a sufficiency of equity capital, in fact, induced the insufficiency of capital. As I mentioned, there was no free capital. That's something obviously that you cannot regulate. But as I mentioned, there also was very little regulatory capital. And that had to do with the model-based approach, which since 1996 has enabled the large banking institutions to use their own quantitative risk models in order to assess their capital requirements. And that has been a major reason for why we have these 1%, 2%, 3% equity ratios relative to unweighted assets. At this point, the banker will say, but the risk model, we need to worry about risks. We need to worry about a risk-calibrated system of regulation. If you believe the models, in the case of UBS, as I mentioned before, the major risks of their involvement in subprime mortgage-backed securities were not in their models, simply because they had forgotten about correlations, dependence on common factors, and about systemic risk exposure. Procyclic effects of this regulation. If the bank has a loss under this regulation, in order to satisfy the regulation, it has to sell assets, a multiplier of 40 or 50 if capital is very small. That depresses markets, has feedbacks onto the markets, and feedbacks onto other financial institutions in the system, which must react likewise. So that to some extent, this activity actually may end up hurting the bank, because this process may eventually come back to it, whereas in principle it should have been designed to protect it. If you ask the question, where does this come from? Well, it comes from a complete lack of conceptual understanding of the effects of regulation. Regulation is based on the notion that if one takes care of solvency of an individual bank, one has taken care of the system. That's just wrong. At this point, a regulator will say, but surely if there is enough equity capital, like 100%, there's not going to be a problem in the system. Then you respond, but with 100%, there's no depositor anymore to be protected, and it's not a bank anymore. Yeah, that's the problem. We really like to have it, but we can't, and that's why we need this. We have this 8% Cook ratio. Of course, when the equity ratio is 8%, the story is completely different. Then you have to ask yourself, what are the implications of corrective actions? Well, as I mentioned, deleveraging can harm. And it will do so if you ask these institutions to sell assets below expected present values of what the returns on them are. And it will also do so through the feedback effects on other institutions. So we don't just need more regulation, we need rethinking about regulation. And one of the things that always strikes me is that no attention has been paid to intervention mechanisms, and no attention has been paid to objectives. If you ask a regulator, what's the objective of banking regulation, of capital regulation, you don't get a clear answer. You get three answers. One is it's a buffer. We've heard about that. One is it's an incentive device. That's actually a latecomer imported from the theorists. The third one is it gives you room to intervene before the bankruptcy judge takes over. Now, these are three objectives. They have different implications for the standards of regulation and for the procedure of intervention. I've never heard the problem of, or read, the problem of conflicts between these three objectives and the implications for standards and modes of intervention being discussed. So, I'll conclude with three very simple ideas for reform. The first one, we should eliminate the notion that risk control in the bank and risk control by the regulator are there in pursuit of the same objective. This notion has been a major reason for why the industry, this is in the slides that I've just skipped in the interest of time, for why the industry has been able to capture the process of regulation in the 90s in use and to get the model-based approach implemented. Referring to the model-based approach, if we look at current reform discussions, all discussions go in the direction we need to refine it. I've not seen any discussion of how can we counteract the effect that this approach has been a reason for why bank capital has been so low, and how can we deal with the fact that there are risks which are not captured by the model. So the second element is we need to have some elements of the regulation that don't require the regulation to be right, the models to be right. There must be some notion that banks have to provision for something that they do not foresee and the regulator doesn't foresee. Third point, we should have some mode of intervention, some intervention mechanisms that will reduce or eliminate the procyclic effects, the crisis-enhancing effects, or on the upside, the bubble-enhancing effects of the regulation that we currently have. We're probably closest in terms of reform discussion on the last element, although even there, I'm afraid that the proposals that I've seen go too much in the direction of yet more precise measurement, too much overconfidence in the ability to engineer by formulae, but at least an improvement over what we've had so far. I have not seen much improvement, much progress on the first 2 points on this slide. In particular on the first one of the things that amazes me is the extent to which an industry that should be entirely intellectually discredited by the experience of the crisis and its own contribution to the makings of the crisis, by the extent to which this industry is still intellectually dominating political and regulatory discussion about reform. And on that note, I want to close.
So we have got quite a lot of questions during the presentation. I will start with some of them. The first one is why the financial analysts who follow severe short of ethics haven't realized that subprimes and securitization were unfair and dangerous for clients. And why has the Glass-Steagall Act been repealed after all?
Okay, on the first question, herding, stupidity, political correctness are three answers that I could give. Stupidity, many people don't think things through. I remember discussions in the mid-90s in the US. I mean, I had worked on these things as of the mid-90s, as Henri mentioned in the introduction. And I remember discussions where I asked people, what do you do about the implications of the transfer in liability for incentives to assess creditworthiness? And I would get the response, and mind you, this was not analysts, but academics. No problem. We have these wonderful new techniques. We form packages of these securities. And by having these packages of these securities, and there's enough independence in them, the risk disappears. My response was, well, if you take a package of bad risks, I don't see why that becomes a good risk and why this incentive problem disappears. But there was, by responding that way, I was just showing that I was a yokel from the provinces. Which brings me to the next point, political correctness and herding. If everybody else has a standard that this is the game to be following, you're making a bad name for yourself if you disagree with that. You can ask exactly the same question about why did banks send so much money to Latin America in the late 70s? I've had conversations with bankers saying that even after we appreciated that this was going to be a huge problem, we couldn't get out of it because our reputation loss would have been tremendous. Why was Glass-Steagall repealed? Well, lobbying. Commercial banks wanted to get into investment banking. If you have enough lobbying, and it seems rewarding enough, these things work. Why didn't the Swiss National Bank succeed in getting a leverage ratio regulation imposed prior to the crisis? Same phenomenon of capture.
Another question more related to Germany. Will the Landesbanken survive the next time bomb? Lending and guarantees to the shipping industry is probably more than 100 billion. Market loss today about 35%.
Total exposure of German banks to the shipping industry is about 100 billion. And of course, we know that all these markets are not working and therefore mark-to-market is not applied. I've looked at this problem and I worry. In the case of HSH Nordbank, this is the Landesbank of Hamburg and Schleswig-Holstein. Well, last year they experienced losses which reduced their equity from 5 billion to 2 billion. It was since replenished. Over the first 6 months of this year, went down to 4.5 again. Total exposure in shipping, 34 billion. So if you don't need the number that was given there in order to see that there's a really serious problem. But on the question of will they survive, of course they will survive. If you're a minister president of a German land, no price can be too high in order to save your extra parliamentary financing facility. And of course, no price paid by the taxpayer.
A more general question now. Could it be possible to think that the US economy and therefore the world economy is built on a kind of Ponzi system, Ponzi scheme, and therefore if the US market is bullish, it can be adjustable, and if the markets are very bearish, it ends in a world economic crisis?
I use the word bubble in between. We have, of course, had a stock market bubble in the late 90s. We had the real estate bubble in the US. I've talked about the downward bubble. Quite definitely in the short run there can be bubbles. But I doubt that we could say that the entire economic system is built on bubbles. One thing which is of interest in this respect is that different bubbles have different consequences even when they burst. And typically, real estate bubbles are much more harmful than stock market bubbles. One of the amazing experiences of this decade is that the burst of the tech bubble in the stock market had very soft, not very serious effects on the real economy. There was a recession, but nothing very deep.
And why not oblige banks and neobanks to publish details of their asset portfolio every month or so? Not supply the regulator with this information, but the public at large, that the public becomes the regulator.
Banks do publish significant amounts about their portfolios. The stuff that we had no transparency about was in their shadow banking system outside the official financial sector. As for the public at large becoming the regulator, that's of course the notion that we have something like market discipline. I don't believe that market discipline works, or that market discipline is a device to avoid crises. I mentioned that market discipline was failing in the upswing. It did not prevent people from engaging in crazy strategies. I was also suggesting that with the downward bubble, we might have had an exaggeration there, which led to markets falling farther than they would have had in a system that might have had more patience. So I don't think that just relying on the public would really solve the problem.
Thank you. Then there are two questions about accounting, the accounting system. One is, should fair value accounting be abandoned or amended? How do you reduce its pro-cyclical effects? And do you believe that IFRS is a good accounting system? When can we expect a better system?
There is no perfect accounting system. Fair value accounting has certain advantages and certain disadvantages. To explain the advantage, going back to the American savings and loan crisis, I mentioned before that as of 1980, about 2/3 of American savings institutions were insolvent. What do I mean by that? Well, they were sitting on something like a 40-year fixed-rate mortgage issued at 6% in the year of 1965, with still 25 years to go, and were paying or having to pay interest at money market in a situation where money market rates were in the double-digit numbers. Now, if you earn 6% and you have to pay 11, 12, or 15%, you have a problem. They carried this 6% mortgage at face value because the debtors were paying up and there was no reason to write it down. And there was no taking account of the fact that there was this serious mismatch in the institution's balance. The discounted present value of the debt service on this mortgage at current market rates would, of course, have been far less than face value. Not acknowledging this fact meant that when these institutions were deregulated, they went off and, as the formulation has it, gambled for resurrection. Heads, I win. Tails, the taxpayer loses. The second part of the savings and loans crisis, the one that broke out in the late 80s, was the result of this gambling for resurrection. And there are estimates saying that even though the losses ended up being smaller than was feared at the time, still they were a multiple of what they would have been if the mess had been cleared up in 1980. So this is a case where fair value accounting, which would have required them to put the change into their books, would have made a difference and would have been advantageous. By the way, it's also a story that makes me worry about current events where I don't really see anybody cleaning up in troubled institutions. So the proper response must be, first, any accounting system has advantages and disadvantages, and there is a trade-off to be made. Second, perhaps the procyclical effects are more a matter of what do we do with this information? To what extent do we force banks to deliver? How mechanically do we handle the system? Then they have to do with the accounting system itself. And it's probably this relation between the numbers and the regulation that's built on them, the intervention that's built on them, that we have to think about.
Yeah, just to add one question to this problem of accounting, there was a proposal that the two systems of accounting could be used. The traditional system for long-term maturities, and then the fair value accounting for short-term maturities. Would it be possible to have such a dual system of accounting?
In principle, that was the idea of having banks distinguish between market risks and credit risks, and similarly for insurance companies. And then banks looked at the fact that for market risks they could use their models-based approach and reduce the equity needed for a certain portfolio, or putting it the other way around, buy a lot more assets with a given underlying equity. And this is why many banks had the stuff in their trading portfolios rather than their credit books. So the moment you introduce this distinction, you have to worry about manipulation of the distinction.
Then a very precise question. For getting a rating qualification by a rating agency, you have to pay the agency, is it true?
My understanding is that the client pays, yes.
And a question in French, well, is it possible to construct systems without any risk?
Of course, the answer is no. I mean, life involves risks. Any choices that you take involve risks. If you cross the street, you see an oncoming car and you decide, well, I can still make it. You engage in a risk. I was mentioning before, housing necessarily involves risks. There's no way to avoid them. The only question is to make sure that we don't have too many of them in the economy, and we should also make sure that they end up in the right places so that we don't get too much of a concentration.
A question about shareholder value and equity earnings. So is it sensible to have equity yields with 2 digits, with an economic growth of 5% of gross national product, and 5% that's already more than what we have?
Well, 5% nominal growth is something that the US might have quite safely if the Fed begins to monetize the newly created government debt. But to be serious about this, I definitely believe that these 25% rate of return on equity that Mr. Ackermann of Deutsche Bank is talking about are a problem. And I'm not bad-mouthing Mr. Ackermann for that. I think he's right when he says that this is a benchmark that has been established and that he himself is under pressure from analysts and journalists to be performing. So at that level, I think it's right. But I also believe, well, and I've heard him actually give a talk on this. He was saying, well, sure, that's high, much higher than for than rates of return on equity in the non-financial sector. But don't forget, banks have much lower equity, or banks can do much more with the equity that they have than firms in the non-financial sector. That's the point at which I would cut in and say, now wait a minute. Perhaps doing so much with the given equity that you have is a way of taking risks, and the 25% is just a risk premium. And to the extent that this is common in the banking industry, it may be a benchmark that comes about because the entire banking industry is subject to the same banking regulation. Not the entire, but the banks that are relevant for comparison. So that perhaps this is the point where we have to again think about the equity regulation and what are mechanisms to make sure that there's more equity, so much that the issue of solvency doesn't really arise, and the issue of vulnerabilities through the breakdown of interbank markets doesn't really arise.
A very, very general question now. Is it possible to experience a crisis so deep as the one that we experienced last year? And will it be that the next generations will know their own crisis?
I'm reasonably sure the next crisis is going to come. Moreover, if things aren't cleaned up, the next crisis is not going to be any nicer than this one. As for every generation has a crisis. That's optimistic. If I go back to the mid-70s, well, I've mentioned on a number of occasions the S&L crisis, early 80s, late 80s. Late 80s, early 90s involved lots of crises all over, including Switzerland, the crisis of the regional banks and cantonal banks in the early 90s. Sweden, Finland, Norway, Denmark, Japan. There were banking crises all over. 94, the peso crisis. Oh, I forgot the Spanish crisis of 1982. 97, the Asian crisis, or crises, I should really say. 98, LTCM and Russia. 2001, Argentina. Since the mid-70s, we've had one crisis after the other. And the one difference is that, well, there hasn't been much of a crisis between 2002 and 2007. And then this one has been much tougher than the previous ones.
There were two questions about the risk raised by credit cards. Do you think that more violent crises will come in the near future due to credit card lending?
I have no idea. I know the numbers involved in the credit card business are large. I also know that there are significant amounts of bad risks. At the same time, I have a suspicion that these risks may be somewhat more diverse than risks in mortgage borrowing. And therefore, I'd be less pessimistic on that account.
And finally, a very personal question. Would you buy UBS share now?
I have no idea of what the share price of UBS is at the moment. As a matter of principle, I don't buy shares of a single company. I only buy index funds. Mine funds, not certificates. If I want to buy shares of a single company, it'll be only for amusement purposes, so I have something to talk about after reading the newspaper. I think the worst investment I ever made was to buy shares of Borussia Dortmund when they were first issued, but still I don't regret this. We gave some of these shares to one of our sons for Christmas, and the entertainment involved in that was worth it.